Welcome to Talk Tickers. Today we're breaking down the Prologis Q4 2025 earnings call. And wow, this was a big one. It looks like the cycle is finally turning, and on top of that, the company revealed a really major strategic pivot. Let's get into it. All right, let's jump right in with the headline number that really grabbed everyone's attention. Prologis delivered a massive GAAP EPS beat. We're talking 79 cents above what analysts were expecting. That's a huge surprise to the upside. So, no surprise, the market really liked what it saw in the pre-market. Let's dig into the core numbers that got everyone so excited and see what the real story is here. So as you can see, we've got a pretty significant beat on both GAAP EPS and total revenue. Now, core funds from operations, that's FFO, a really key cash flow metric for real estate companies, that came in right in line with what the street was expecting. And you know what that tells me? It shows really solid, predictable control over their operations, even while they were absolutely crushing it on the top and bottom line. Okay, so beyond those headline numbers, the operational metrics, they tell a whole other story. A story about a business that is just performing exceptionally well in its core logistics segment. Get this, they finished the year with occupancy at a whopping 95.8%. And look, that's not just a high number on its own. It means they're outperforming the broader US market by 300 basis points. That just screams quality, the quality of their portfolio and their entire platform. Okay, but this is what's really interesting. Check out the net effective rent change. It popped an incredible 43.8% for the quarter. This right here is the engine room for future growth. What it does is create this huge amount of what we call embedded net operating income, or NOI. Think of it as profit from their properties just waiting to be unlocked as their old, lower rent leases roll over to today's rates. And here's where you see that pricing power in action. Their cash same-store NOI grew a very healthy 5.7%. And not only that, they beat the midpoint of their own guidance. It's simple, really. Strong demand plus high retention, that translates directly into more cash flow. You know, management's whole tone on the call was just really constructive. And this quote, it just captures that vibe perfectly. They're basically telling the market, hey, we think vacancy has peaked and rents are starting to turn up. That signals that the logistics cycle has bottomed out and is now turning a corner. And believe me, that's a major, major shift in sentiment from what we've heard in previous quarters. All right, so let's shift gears and look at the forward-looking guidance. We need to see how this all builds into their plan for 2026, because honestly, this is what the market was really focused on. So their initial 2026 core FFO guidance is in a range of $6 to $6.20 per share. Now, that neatly brackets the Wall Street consensus, which was sitting right around $6.13. So how did the market read this? Well, they saw it as credible and steady. Look, it wasn't some kind of crazy blowout guide, but it was a strong, achievable plan, and that's the kind of thing that really underpins a stock. They're also guiding to $3 to $4 billion in new development starts. But wait a minute. The crucial point here isn't just the dollar amount. It's the composition of those starts. What they're planning to build signals a really major strategic shift for the entire company. And this, my friends, is where the long-term story gets really, really interesting. Prologis isn't just a logistics company anymore. Nope. They are pushing this whole new narrative of platform expansion. We're talking about getting into power and digital infrastructure. And get this, for the first time ever, management has come out and said that roughly 40%, 40, of their development starts next year will be for data centers. That is such a significant pivot. They're taking their unique land bank and monetizing it in a completely new, incredibly high-growth area. And you know, they're not just winging it here. They have a very disciplined 4-step process for this data center business. First, procure the power, which is the hardest part. Second, secure the leases, usually built to suit, which totally de-risks the project. Third, deliver the facilities. And fourth, harvest the value. Simple, smart, and effective. Now, this isn't just some pipe dream. They've already secured or are in advanced talks for 5.7 gigawatts of power. And management even signaled that the total opportunity, when you look across their entire land bank, is around 10 gigawatts. That is just an absolutely enormous pipeline. And just to put that into perspective for you, 1.2 gigawatts of that power pipeline is already in letters of intent or has a lease pending. What does that tell you? It shows real, near-term, tangible progress. And it proves there's exceptional demand from tenants for these data center sites. Okay, so let's put this all together. What do we got? We've got strong Q4 results, a nice steady guide for the year ahead, and this compelling, absolutely massive new growth story that's unfolding in data centers. So, the big question is, what's the trade here? How do we position ourselves for the year ahead based on everything we just learned from this call? Well, it's clear the whole investment debate has shifted. Last year, the market was all worried about defense. Can Prologis protect its income in a soft market? That was the question. But now the conversation is all about offense and growth. It's how fast can they capitalize on this new data center opportunity? So, based on this call and the really clear strategic direction they laid out, our rating on Prologis is outperform. Why? Because we think the market is still underappreciating two things: the turn in their core business and the sheer scale of this new data center growth driver. So let's just run through the key points supporting this rating. It's pretty clear. First, you've got the logistics cycle turning, which is a nice tailwind for their core business. Second, you have that durable stream of income from all that embedded rent growth we talked about earlier. Third, the data center strategy. It's this massive growth option that we don't think is fully priced in yet. Fourth, they have a clear, disciplined plan to get it done. And finally, their balance sheet is rock solid with $7.6 billion in liquidity, so they have the firepower to execute. So what's the trade? You're getting to be long a best-in-class industrial company right as its core business is turning up, and at the same time you're getting what's essentially a free call option on what could become one of the largest data center platforms in the world. Of course, this is not financial advice. All of the content here is for informational purposes only.